take more tests.
Yeah. And just tell me um just tell me what are just tell me what are the things that you're having trouble with and we'll go over that together, okay?
Okay, yeah, I'll put a list tomorrow, so when we
Yeah.
go in, we could probably like if anybody else wants to join up or something, we could all go over it.
All right, cool. All right, here we go. The current interest rate on an equity index annuity. Oh, we that was a variable question, huh? Yeah, that was. All right, that's okay. Let's go over the variable part. Okay. In the test, this is a must. Huge. All right, guys. You see the word variable right there?
Hmm.
Oh gosh. It sucks when this happens. Right here. All right. Whenever you see the word variable on like variable annuity, variable products, variable life, okay? It doesn't matter what the second word is. If you see the word variable, you got to be thinking of two things. Number one, it's risky, therefore, you need a separate account. So the insurance company on any variable product, like a variable life insurance or variable annuity, they need to put the money in a separate account because it's risky. It's like you. If you, let's see, what's a good example? Separate. Yeah, you want to separate, like, I don't know. If any of you guys like to play poker, you gamble or whatever. I can't think of another example. Okay, guys. You're
Hmm.
betting something. You're not gonna bet and put your wallet to bet, right? If you want to bet, you might bet like $10 or $100 inside your wallet. You're not gonna bet your whole wallet. You see what I mean?
Yeah,
So what are you doing? You're separating the money because it's risky. You're betting. See what I mean? You're not gonna you're gonna you're not gonna say, hey, let's bet $100, and then you pull out your wallet and you put your wallet there. No, you're gonna open up your wallet and separate $100 into the pot because it's risky. You're avoiding the rest of your money, losing the rest of your money. You see what I mean?
yeah.
So when you see the word variable, you gotta think risky, therefore separate account. Okay. All right. What's the opposite of separate account? All right.
Um,
Here goes ready. So I'm going to put versus general account. Gen general account. Okay. So if it's not in your separate account, then it's in a
general.
general account. Yeah. Can I do this? How can I? Got it. All right, guys. So versus general account. So general account, you could say it's your wallet. It's your money, right? But if
Hmm.
it's risky, you're going to take some of that money and put it in a separate account. Okay.
Yeah.
All right. The other thing that you should that should going through your mind when you see the word variable, the other thing that goes through your mind has to be this. You need a securities license. You cannot sell securities license with you cannot sell variable products without a securities license. Does that make sense? Okay? It's really important that you guys make that connection. Who regulates the securities license? The FINRA. Okay? FINRA. All right. That was securities. Okay, now let's talk about the current interest rate on an equity index annuity is often based on what? When you see the word equity or index or equity index, you should be thinking about the Standard and Poor's, the S&P 500.
Okay.
Now, this is tricky though. This is a tricky one. That's not the answer. It's going to be in the insurance company's general account investment, the current interest rate, the annuities, individual stock, the returns on interest. I think it's B. Oh, I was A, damn it. Okay, this one's very tricky, man. Let's read the rationale here. It says equity index annuities are not securities. but they invest in a relatively aggressive basis on a high to aim for higher returns. Interest rates of on equity index annuities are often tied to familiar index such as a Standard and Poor's 500. But this one got me because it didn't say interest rates. On the question it says current interest rate. All right. So that one got me. Any questions on this one?
Yeah.
And
So
I did
would
say it
it
in the
be?
beginning. If you have equity index, if you see the word equity index, it's tied to an S&P 500. But I just thought it was talking about the nominal interest rate or the minimum interest. Go ahead, Brandon. What's the question?
So say if it was B, how would the question like approach? Like, would it say like it wouldn't be like the current? Would it be like the last interest rates or something for the answer to be B?
Oh, the answer to be the insurance company's general account investment. This one, the the minimum interest rate, maybe the general account investment, which is the company's return. Yeah, we're just gonna have to wait to see one because I can't think of it off the top of my head. The interest rate, it's like I think it's called the nominal interest rate, but I'm not 100% sure. So
Okay.
we'll come across it again. We'll come across another question like that.
Okay.
Because the equity index has a minimum guaranteed interest. I think that's what it's called, minimum guaranteed interest rate from the insurance company's general account, minimum guaranteed interest rate. So it has a minimum guaranteed, and then here, let's look it up right here. Let's go. Interest sensitive market. Um, let's see. Variable. No, we're looking for equity index combination plan. Nope. We're looking for equity. Equity. Let's go all the way down.
Yeah.
Equity. Equity index. Equity. Where are you at? Equity. Equity. Here it is. Equity. So let's read it. It says equity index annuities are fixed annuities that invest relatively aggressive to aim for higher returns. Like fixed annuities, the index, there it is right here. You see that? The index annuity has a guaranteed minimum interest rate. That's the
Oh,
one.
okay.
And this one comes from the general account. Okay.
Mm-hmm.
So it says, which provides a guaranteed for a certain rate growth. And at the end of the contract, the term annuity will credit to the greater of the guaranteed minimum or the current interest rate, which is the index value, how the S&P 500 grows. See
Okay.
that?
Yeah.
And this is in the general account because it's not variable. So if it has a word variable, then it's separate account. But if it doesn't have the word variable, then it goes into the general account. Okay?
Okay.
Yeah. All right. Let's see. Let's go back to the question. That's good. I'm glad you asked that, bro, because that way we could reference that. That's good.
Show.
Number six, which of the following is not true regarding the annuitant? Which of the following is not true regarding the annuitant? So, who is the annuitant, guys? Who is the annuitant?
Um,
Who is the
the
annuitant?
the beneficiary.
The close, but I want you guys to tell me like what the wording on the test. It could be the policy owner, but it could also be not the policy owner. But the annuitant, what does he get? He's not the beneficiary. The beneficiary is the person that gets the money after the annuitant dies. You see what I mean?
Oh,
So the
okay.
annuitant is not the beneficiary, but it's a close concept to it. So here it is. You ready? The annuitant is the person that receives the income. When the annuity pays out, the annuitant is the person that actually receives the income coming into him, the retirement income. Okay.
Oh,
All right, so that's what it's referring to. So you got to know that if you're going to look at a question and you're going to be like, all right, I know what an annuitant is. The person that receives the income. Okay, let's talk about it. A. So we're looking for which one is not true. Okay. The annuitant receives annuity benefits. Is that true? That's what
Yeah.
I just told you guys.
Yeah.
Yeah, that's true. But that's not the answer because we're looking for the false one. So that's not the answer. Let's go look at B. The annuitant cannot be the same person as the annuity owner. Can it be the same person or not?
Yeah,
Right
for
here
sure.
it's right here it's straight up saying it cannot. But the answer is it can. The answer is it can. Tafoya. A ver, Kyle, bro. I need a coffee, bro. My copita negra, I think I left it over there. Go get some coffee, bro. Do we have coffee? Do we have coffee? Pues mejor hazme un coffee. Is there a creamer? The powder creamer. I'm so bougie, bro. Here, give me a coffee from Starbucks. No, just a regular coffee and yeah, yeah, but oat milk, steamed oat milk and 3 raw sugars. Thank you, bro. All right. Which of the following is not true regarding the annuitant? So where were we at? Oh yeah, this is the answer because that's false. That's a false statement. The annuitant could be the owner of the annuity, but it also doesn't necessarily have to be the owner of the annuity. For example, I could buy an annuity for my dad, where I'm the owner and my dad is the annuitant, right? So is my dad the owner? No, I'm the owner. Also, here's another scenario. I could buy an annuity for myself. So I'm the annuitant and also I'm the owner. Make sense?
Yeah.
So that's why B is wrong. So C is true and D is true. Let's find out. The annuitant's life expectancy is taken into consideration for the annuitant. Yep, the annuitant. To determine the payout, they look at the um ¿cómo se llama? They look at the annuitant's life expectancy. D the annuitant. Hold on. The annuitant must be a natural person. The annuitant must be a natural person. Yes, what is a natural person? A human being. So in other words, it cannot be a person on the test is a human being, but also a corporation. You see what I mean? And
Mm-hmm.
a trust and stuff like that. What's up? Oh, yeah. So a natural person is an actual human being. Okay. Thank you. Human being. Natural person is a human being. All right. Let's continue. Submit. Next. Which of the following is another term for the accumulation period of an annuity? Which of the following is another term for the accumulation of an annuity? What do you guys say? What do you guys say? What do you guys say? What do you guys say?
A liquidation period?
Liquidation period. Which of the following is another term for accumulation period? No. Remember, accumulation period is what does the word mean? Accumulation.
What's like
You're accumulating, you're
like fun?
accumulating money. So that means you're growing your money. You're piling up money. You're accumulating money. You're accumulating funds. You see that? So the accumulation period is actually the pay-in period. You're putting in money into the annuity. You're paying in to accumulate. You're paying in to accumulate. That makes sense, right? So think
Yeah.
of it like that. Liquidation period is the period where you're cashing out, you're liquidating money. So that's called the annuity period. See, A and B, they're the same thing. Annuity period and liquidation period are the same thing. So just knock them out of the list because that's already. So right here, you might be tempted to put premium period, but that's bogus. That doesn't exist. That's not on the test. They just made that up. It's called a pay-in period, okay? Now let me show you a visual. You got to see a visual. You have to see a visual. Okay, I'm going to show you a visual. Come on, zoom out, bro. Oh gosh. Thought you were a Mac with a M1 chip, M4 chip. Crashed on me, bro. All right, you see this right here? Here's a visual of an annuity. It's accumulating money. The accumulation stage is also called the what? The
Accumulation period.
pay-in, the pay-in
Oh,
period. I'm gonna write it down right here for you guys. So it's a pay-in period. Got it?
mhm.
Right there. But then you reach what is it? What does it say right here? Retirement. You reach retirement age. I know it's misspelled. And then you start liquidating the money. It's called the accumulation period. I mean, annuitization period. You choose a settlement option here. So I'm gonna put liquidation right here. Liquidation. Bam. See that? It's good. Make sense, guys? All right.
Yeah.
Let's continue to the next one. The death benefit under the universal life option B. What is option B? Remember I mentioned option B?
Where
What is option B, guys?
I believe is level. It's like somewhere
Is is
really
it
level.
is option B level death benefit or increasing death benefit? Trick question. No, it's actually not a trick question, but I could see how people get them confused. All right. It is a little confusing, to be honest. What's up, Ruby? So option B is actually increasing death benefit. So gradually increasing you by the amount of cash value that increases. Bam. So option B is increase. How can you remember that? I'm still trying to figure out a way for you guys to tell you guys something that you guys be like, that's all I'm gonna remember. Option A is level, A level, B increasing.
I have a question, bro. Is
Go
it
ahead.
always when it's universal life, option B, would it be increasing, like gradually increasing?
Say it
Like,
again. Ask me the question again.
so every time we see universal life option B, would it always be gradually increasing? Like no matter
Any
what?
all the time, bro. Option A is the one that is level. Option B is always increasing 100% of the time.
But is that only with universal life?
Yes, sir. Great question. Universal life is the only thing that offers uh, different death benefits,
Different options?
different options. Only universal life. Anything that has the word universal life. So if it has, if but universal life is also known as what? Flexible premium adjustable life, right?
Yes.
So if it says flexible premium policies or adjustable life policies, it also has option A and option B. Got it?
Okay.
Variable universal life. Does that have option A? Yes, because it has universal life in it. See what I mean? Just because it has the word variable in front doesn't mean that it doesn't have that benefit.
Yeah.
If it has universal life anywhere in it or flexible premium adjustable life, it's it has two different death benefits. Okay, so here it is. Right here. Oops. Right here. Universal life have option A and option B. All right. Whole life, does it have option A, option B? Nope. It just straight up matures at age 100.
Okay.
Face amount equals your cash value. Policy terminates, you get the cash value. Okay.
Mhm.
Oops. Where are we at? Right here. So I haven't thought of about a cool way for you guys to memorize it. You're just gonna have to remember that option A is level and option B is increasing. Okay. Just remember that.
Okay.
Number nine, which of the following is true regarding the premium in term policies? Premium term policies. What happened to premium term policy? The premium is level for the term of the policy, period. Only level term policies have a level premium? No. Increasing term has level premium. Decreasing term has level premium. Decreasing term policies have a decreasing premium? No, it has a decreasing death benefit.
Mm,
D, the premium in term policies is not based on the insurance age? Yes, it's exactly based on the insurance age. Got it, guys?
yeah.
So here it has to be A. There it is. If the what time is it? Almost time. If the owner of a whole life policy who is also the insured dies at age 80 and there is no outstanding loans in the policy, what portion of the death benefit will be paid to the beneficiary? The full death benefit. Because there's no loans. If there was a loan, then the death benefit goes up or down. If there's an outstanding loan, it goes down. It goes down because if you borrow $10,000, they're going to take it from your death benefit when you die. That's ridiculous, by the way, because you're literally paying for both and and they take away one. It's crazy. Like, guys, if you're studying for this and you're planning on selling whole life or universal life, especially index universal life, do not do it. It's a ripoff. Hit me up. I'm gonna teach you how to be profitable selling term insurance. That's the right thing to do.
Okay.
Um, okay. The face amount minus the premiums that would have been collected until the insured reaches the age of 100. So, what portion of the death benefit will be paid out to the beneficiary? The face amount minus the premiums that would have been collected until the insurer reaches the age of 100. That's not true. They just get the death benefit. 50% of the death benefit? No, there's no outstanding loans. And D says a death benefit equal to the cash value? No, you lose your cash value if you die. You just get the death benefit minus your loans. See that?
Mm-hmm.
So whole life again, whole life insurance policies guarantee a death benefit. But if you owe money, they'll reduce it. See that? So it says if the insured lives at age 100, it's worth repeating, guys. I'm just repeating it, okay? If the insured lives to age 100, the insurance company pay the owner the face amount equal to the cash value. However, if the insured dies prior to the policy maturity date, the death benefit is paid to the beneficiary. It didn't mention minus loans, but it's minus loans. We'll find another one. Straight life has what type of premium? Guys, straight life is also known as whole life. All right, so let's write it down. Let's go here. See that? Straight life. I'm gonna put it right here because it's actually not here. That's good. I'm adding notes as we go. Straight life. So I'm gonna put AKA straight life. Okay. Let me make this bigger. Oops, not that big. There it is. Okay. You guys got it?
Yeah.
Any questions?
Mm-hmm.
All right, so straight life. So if now that you know that straight life is whole life, what's up? And increasing. All right, hold on, guys. Okay, give me a second. Okay, what's the answer, guys? What do you guys got? I gave you guys a little time to go ahead and know what the to see if what I'm curious to know if you guys got it. Hmm?
Nuevo año.
An increasing annual premium? No, straight life is level premium, level death benefit.
Mhm.
So it's not A. B, a variable annual premium? They're just making crap up for B. A decreasing? No, a level annual premium. That's what you said, huh?
Yeah.
That's right. That's right. That's right. Good job. Okay. Make sense, guys?
Yeah.
Yeah. Look at it here. Whole life is the death benefit is leveled. You see the red line right there? It's leveled. And the premium is leveled. See that? It's only it's only red or like the other ones, a graded premium, modified, limited pay, single premium. It's only that if it says in the front. But if it just says straight life or whole life, it's level level. Okay? Level level. Which policy component decreases in decreasing term insurance? What decreases, guys? The face amount or the premium? The death benefit or the premium? What decreases on decreasing term?
The face amount?
Face amount? Yes, good job. The face amount. All right, here's a visual. You got to see it. You got to see it. So what is this? Annual renewable term. So here, see that? What is it?
Mhm.
Decreasing term, right?
Hmm.
So decreasing term, what decreases? You see that? You see the little ladder and it says face amount death benefit. Premiums are leveled. Which of the following life insurance policies allows a policy owner to take out a loan from the policy's cash value? Does term have cash value? Does term
Mm.
have cash value? No. So you could get rid of B and C. You see that? And the and A,
Oh,
dude, this is easy. Boom. The answer is D. This has term, this has term, this has term. This is easy. This one's a giveaway. I hope you guys don't get this one wrong in the test, okay? Any questions? Oh shoot.
no.
Hey,
Mhm.
let's finish up these two, okay? We're done because 7 o'clock, we're almost about to start the training.
So,
An insured purchased a life insurance. Give me 1 second, guys.
policy.
And the agent told him that depending upon the company's investments and expense factor, the cash value could be changed to those shown in the policy. This is an interest sensitive whole life. Okay.
Okay.
This one is rare. I'm not even gonna go over it. It's not that common to for it to come out on the test. Which statement is not true regarding straight life policies? Remember what straight life is? It's whole life.
Hmm.
Yeah, let's double check. Let's double check. Let's double check. There it is. Straight life, whole life. It usually develops cash value by the end of the third policy year. That's kind of true because of the surrender charge. The face value of the policy is paid up to the age of 100. 100? Yes.
Hmm.
It premium steadily decreases over time in response to its growth in cash value. No, it stays the same.
Hmm.
And it's the lowest annual premium from the three types of whole life. Oh, dang. Its premium steadily decreases over time in response to its growth in cash value. Oh man, it has to be C, bro. Yeah, it's C.
Okay.
D also doesn't look right, man. Something looks wrong about C, a D, but I guess that's true. All right, guys, we're good to go. Let's go.
All right.
We're
Then thank you, bro.
all right, champ. Let's go. Keep studying. Focus. Put your time in. Let's make it happen.
All right.